on the top right, you can see some numbers about cases as of today for worldwide, and then of course on the lower right, some stats on the pricing of oil and some general ranges of projections for those prices as they go forward. All of these are big factors that affect us here locally and us as business owners. And the key is that we are currently in a time of crisis between the oil prices and the COVID-19 and business shutdowns. It's impacting us. So the questions that today's presentation are intended to address, and I by no means have all the answers, so I'm going to kind of breeze through the slides here, but I really welcome some active Q&A and discussion as well, because I think the best way for us to come together as a chamber in particular is for us to utilize the strengths of our collective expertise and our support of each other and our knowledge and background in running businesses and making the best of even bad situations. But I want to first talk to you guys about what impacts business valuation. How do we determine what your business is worth, and how is our current crisis environment affecting that value? And then based on that and understanding the components that make up a valuation, we'll then jump into what are the best ways to stabilize that value. And then from there, how do we strengthen so that we can become stronger even during crisis, but even more importantly, after crisis. So in general, with valuations, there's a bunch of different ways to do it. And I've got some details in here in the slides for those of you who want to get more wonky and delve into it deeply. So I'll kind of go over them pretty quickly. But at a high level, you just need to understand that when you start talking to lenders, or you start talking to buyers, or just as a business owner, when you're stepping back and looking at what's the point of what I'm doing, obviously you're providing a product and a service that you feel is meaningful and important to the community. And that even if your business never has any exit value in the end, is still a value that you're providing to the world at large. But often entrepreneurs also want to know that what they're doing not only has immediate value for purposes of personal income or for satisfying services and products to the community at large, but they also want to know that they have an asset that they're building and growing over time. And that's where valuations come in. So when you look at valuations, you need to understand there's several different ways of looking at it. In general, anytime you're going to determine the value of a business, sorry, I'm over flipping. Anytime you're going to determine the value of a business, you're going to look at your last 3 to 5 years of financial performance, which typically is reflected through your tax returns and or P&L statements. Lenders and or brokers then go through a process of determining what they call seller's discretionary earnings. That really is a way of saying adjusted net income. So you've got your revenues, you spend all your money that it takes to produce your product and get your service delivered, and your net income is what's left. Often, as you know, with business owners, you may have some one-time expenses that come up in a given year, or you may have some things that you're doing because you're trying them out to see about new marketing approaches or new products, but they may or may not pan out. Or you may have certain expenses that are for the benefit of your business, but they're also for your own personal benefit. So discretionary earnings is basically the way of saying your net income adjusted for removal of any non-cash expenses like depreciation, amortization, removal of expenses that would not be relevant to a new owner, so financing expenses such as interest and taxes specific to an owner, and then of course one-time or extenuating circumstance expenses. And that last clause is important because in the time of crisis like coronavirus, we definitely would define that as an extenuating circumstance. So to the extent you see an impact to your financials due to crisis, it could be some portions of that impact can be considered an adjustable expense for the purposes of valuation. Then lastly, you look at your balance sheet. So what are your tangible assets that are included? So you've got a value to your income stream, which is your sales minus expenses adjusted for things that a new owner wouldn't have. And then you have your tangible asset value, which is basically the value of the actual product, furnishings, fixtures, equipment, inventory that you have. That's the high level. There's basically 3 ways that are mostly used. There's actually probably about 10 to 15 true models that are used, but you basically look at your valuations using market multiples, which is similar to when you're thinking about real estate and you're looking at buying a home and you have a realtor run a comps report for you to tell you what are comparable sales in the neighborhood. The same idea applies to market multiples. You're basically looking at other done deals and comparing deals of similar traits to your own business, and then using those parameters, that's what defines the value of your business. The other model is multiple of earnings, which is using that same concept we talked about before with your adjusted net income, the discretionary earnings, or SDE, and then applying that against market multiples, average multiple against net earnings, or average multiple.
As we have been doing of late with today's updated numbers and charts, and may this never become just about numbers.
Apologies, one second, I just got an interruption.
And
then the last is the buyer's test. And that one is basically, does it make sense for someone else to buy your business? So even if you think your business is the golden baby and everyone should want it, the reality is if someone else comes and buys it, and if they have to borrow money and then do expenses to take over your business, and in the end, the cost of that debt outweighs the net benefit from the net income, then it doesn't make sense for them to do the investment when they could turn around and invest that somewhere else. So this little graph here just kind of shows you in general how a business broker or a lender might look at several different models to figure out what is your business worth. It may be that using discretionary earnings and some statistical regressions, they come up with a price of $500,000, for instance, using market multiples 480, and then using a buyer's test 495, and then when they average all that together, you come out somewhere in the 495 to 510 range. So you would likely see a market value estimate of around 500,000. Every single business is different, and that's something during Q&A, if you have specific parameters to your business that you're wondering about how that might be affected, let's throw that out there because it may be something meaningful to someone else as well. And then I can kind of walk you through the points to think about. This next slide will just breeze through. It shows you how the market multiples are determined. Often people will hear news reports about private equity buying a tech firm for 18 times earnings or 22 times earnings. The average for small businesses priced under $2 million is 2.3 times net discretionary earnings. So you'll often hear talk about in the news, and it's all based on size. The bigger you are, the more valuable you're deemed to be. So when you're looking at 100 million or $1 billion companies and up, you'll see multiples that can range anywhere from 10, 15 to 30 times either EBITDA or net earnings. But when you're looking at what's called Main Street, or basically businesses valued under 20 million and on average under 10 million, those are going to be with market multiples much smaller, usually around 2.3 up to about 5 times, depending on a bunch of circumstantial factors. But in general, 2.3 to 2.5 is what we're seeing overall, and with strong businesses running around 3 to 3.5. All of that is pulled together to give you kind of a value of a typical asset sale, which is the top line on this chart of numbers. And then there's adjustments made for any cash, accounts receivable, or any liabilities that you're passing. And the end result of all of that is the bottom line, which tells you basically what is the value of your business. And that's the value that you would consider kind of the net asset value of your business for your own personal purposes, even if you're not looking to sell your business, but if you're intending to use your business as an asset for collateral against other purchases, or if you're just wanting to understand what is my net worth. Important things to consider on pricing considerations is that value and pricing are different. So when we calculate a determined value, that may not be the same as what is the ultimate sale price that you'll get. So you have to remember that in crisis situations like now, where you have distressed businesses or where you have fears or concerns about the economy, those do affect a likely sale price. Also, deal terms are important to price. So when people are looking to buy or sell businesses, whether or not the seller is willing to put a portion of the price as financing on their own, or whether they're willing to put some portions of the price tied to guarantees related to various metrics, those all impact sale price. But the key thing I wanted on this slide for you guys is that focus on what we can control. So the amount of sales that you can bring in it's within your control to the extent that you can be creative on how to find other ways to generate sales or find new ways to distribute your product. The condition of your property, the terms of how you manage your product, services, and your business is under your control. But what you can't control is the type of business you've already got it, where you are located, the interest rates that are happening outside of you, competition, economy, and market conditions. So it's often my advice to tell people it's obviously scary and worrying to worry about the impacts of the virus and the shutdowns and to worry about oil prices. But what you need to focus on is what you can control, not the nervousness and hysteria that's happening from all this stuff, but to instead focus on what you can do with your business to respond to those outside factors. So with that in mind, kind of a high recap of the valuation process: impacts to valuation: revenues. So as your sales drop, your value drops. Net income. So if your expenses remain the same or they increase during these times, but your sales are dropping, then your value drops. And then discretionary earnings. Any of these factors that will impact your discretionary earnings, so one-time expenses. So if you're having to do additional outlays to try to keep your business alive, if you have other non-cash expenses, like you might be doing write-offs, or if you have extenuating circumstances such as major losses of contracts or others related to COVID-19, those are all things that would impact your valuation. But keeping in mind that discretionary earnings will, the IBBA is an organization called the International Business Brokers Association. They're working on a white paper right now that will discuss and hopefully be supported by the majority of lenders, which things can and cannot be adjusted for the purposes of valuation related to COVID-19. So to the extent that you can look at year-over-year sales and see that 20% of your drop in revenues is attributable to shutdowns, for instance, then conceptually we would actually do an add back to your revenues, meaning that for purposes of adjusted numbers, we would be simulating what the sales would be expected to be in a normal time period. So if the last 3 years you were seeing, constant or growing revenues for March, and then March 2020, you saw a massive drop, but then going forward, May through, August, we see sales back to normal after everything started opening, then it's reasonable to assume that the March sales would have been normal if we hadn't had this. And then adjustment is made positively in your favor for purposes of valuation. These are just some quotes from a recent Houston Business Journal article, and I would recommend you guys read it if you get a chance to click on the link when you download the presentation. It's an article that came in just last week about basically how to mitigate value and manage value during times of crisis. But the key thing to remember is that valuation is tied to your expected future net cash flows. So what's happened in the past is just used as a basis to help determine what's going to be going on in the future. But in the end, what a buyer or even what you consider your business to be worth is based on what do you think you can do in the future. Now onto the more fun stuff. And this is more bullet pointed just to give us some kind of discussion points, but all of those things in mind, now that you know what we're using to determine what a business is worth, these are the ways you can look at on how to stabilize your value during the rough times. So the key number one thing that you all know as business owners is manage your cash flow. Obviously, with your store shut down or limited exposure to your business, key expenses are always occupancy and labor. So you want to talk to your landlords and find out what they can do to help you out, whether it be deferring or even waiving various fees and rents. For your payroll, which I don't have on here, but you want to work with your employees to figure out if there's any opportunity for either reductions or deferred payment, or basically just try to keep them to the extent that you feel like it's going to make sense long-term for them to continue helping you support your products and services. And then, of course, the third bullet point is one that we've had a great level of support here at the Chamber, which is from the SBA. Tim Jeffcoats locally has been a tremendous resource, and the SBA has done an amazing job here in Houston and the surrounding area, even relative to the other SBA offices throughout the U.S. We've been able to receive tremendous amounts of the initial round of PPP funding. And then, of course, there's another round that started just on Monday. But of course, to the extent you can leverage those tools and resources, whether it be the PPP loans or the EIDL economic injury disaster loans, both of those are great options despite their huge demand. And if any of you have been trying to get those and have had trouble, feel free to contact me offline, because we do have a couple of options for people whose banks are not accepting applications or otherwise not being responsive. And so that's the cash flow piece. You obviously want to focus on that first. The other, though, is cash in equals assistance to cash flow. So with your sales, get creative. Obviously, you've seen a lot of articles, and we're a little far into the game on this, but in general, with your sales, if you can focus on encouraging customer loyalty, I've seen a lot of really great work done by a lot of our partner restaurants here tied to the Chamber, where they're offering great discounts and opportunities for curbside and delivery pickup. I've seen options where people are able to buy gift certificates for or buy advanced bookings for entertainment type venues where they can buy now and basically have the credit for later, almost the equivalent of gift certificates or coupons. I've seen retailers getting creative even prior to the curbside retail that, as Abbott has started reopening. I've seen them doing virtual tours of their showrooms where they will actually have their customers do a Zoom or FaceTime to walk through the showroom with them to pick things out. So the key is really to get creative and you respond to the current environment and find ways to distribute your product and service despite the limitations that we're now seeing. And then obviously focusing on new products, new target markets. Part of the reality is that as we find people are shifting their buying patterns based on their experience with all this, you want to just make sure you remain flexible and nimble in how to respond to that. People who've been seeing like event venues and similar who've been seeing cancellations or cancellations of product orders, some of the smarter businesses have been responding to that by offering sale or discounted prices in lieu of doing a cancellation, and providing maybe some get out of jail free options if for some reason situations don't change soon enough. So those are all some options. And then lastly, on the stabilizing your value piece is just protecting your employees. I think a lot of people, and it's part of the intent of the PPP loans, but a lot of business owners got really nervous when they saw the overhead looming ahead of them and closures. And we saw a lot of furloughing and layoffs happening. But I would argue that your customers and your employees both will be very loyal and very grateful to those who were able to find a way to make it work, even if you have to get creative with how you structure the payment and compensation for those employees who are willing and able to stick it out with you. And then on the moving forward, strengthen for recovery and growth. This is kind of tied to the same piece, and it's again keeping in mind those key concepts to valuation. But in the end, discretionary earnings is the key driver of valuation. So your cash flow is key. With that in mind, it may be difficult now given the amount of demand against lenders, but in general, to the extent you can build cash reserves and work with lenders to establish credit lines, revolving credit lines or otherwise, that help give you more cushion in the future, that will help. I think many people are finding now about the importance of trusted banking relationships. For those who didn't have trusted banking relationships prior to this, they're seeing some trouble with just getting responses fast enough to be able to get PPP loans and similar. So these are areas where strengthening yourself for future crisis will help you. And then lastly, one thing that some people often overlook is the value of insurance, whether it be business continuity or interruption insurance, key employee insurance, and similar to that. To the extent that you are a key business owner, you don't want your death or your sickness or that of a key employee or a closure of your business to permanently damage the value of your business. Secondly is diversification. Obviously, as you find closures related to physical locations or changes in demand, it's becoming all the more important why you should focus on a multitude of products and services that you can offer. Same thing with your customers. I think some of the businesses, particularly in the oil and gas world, that are finding that they have what we call customer concentration, where any one customer accounts for 10% or more of your revenues, and then for some reason they get hit by a crisis, which then in turn has a trickle-down effect to you. Where you can limit customer concentration such that no one customer has more than 5 to 10% of revenue, that's ideal. Obviously, it's great to get the big fish clients, so you don't want to lose them. But it just means get more so that you dilute the impact in case something happens. And then talent, back to the same thing with your employees. It's often underestimated the value of the intellectual power behind a business. And often that's you as the business owner, and sometimes it's the key employees that you've got. But particularly in times of crisis and for going forward, you want to just make sure they understand how important they are to you and to your business, and recognize that both through compensation, but also through other things such as flexibility, benefits, and other rewards and incentives. And I think that's it for my kind of standard stuff here. And I'll turn it back to you, Tammy, for maybe guiding some discussion and questions, answers, and all that good stuff.
Okay. So if you have questions, include those in the chat box and we'll share that with Mike. You can also see his contact information on screen. Mike, I would love to kick it off with one question. I had a business owner tell me the other day that they are, they've been at it for a long time. They've had their business for about 15 years and they're tired. And this is now having them go, I may think about selling in the next couple of years. when you think about the next couple of years coming out of this, what advice would you give business owners in terms of the things that they need to be doing to plan adequately for that?
That's a great question. The number one thing I'm telling people right now is record keeping. It sounds really boring, but for the purposes of valuations, being able to clearly explain to prospective buyers what's happening with your business is critical. And one of our number one challenges is always being able to have clean books and records. So I would tell you, particularly related to this stuff, the more you can track what you feel is, the more you can get granular with tracking your revenues so that you can understand what is the source of your customers, which ones have been lost, particularly during specific times, and how those revenues trail across various product categories and distribution categories, geographic categories, otherwise. That's very important, as well as the related expenses to it. But in general, record keeping, I would say, because you really need to, whether it's selling 3 months from now or selling 2 years from now, 5 years from now, people will see this time period in particular as a blip, and they're going to want to understand how much of that is just a blip versus potentially indicative of a problem going forward. The further out we go from this time period, the more they will be able to see recovery. But even in normal times, people want to be able to understand, at a pretty segmented basis, an understanding of the numbers. So record keeping is the first one. Obviously, the other thing is, just talking to your trusted advisors, whether it be someone like a business broker. Obviously, I work with my clients several years in advance of a sale often. Other times I get a call where they're at their last rope and they are about to have to go bankrupt or close down within a month or two if we don't get sold. So there's a whole scenario, but ideally, the sooner you start talking to your CPA, your attorney, your financial planner, and or business broker, or other trusted advisors, the better, because it never hurts to just say, what if? Because considering the idea doesn't mean that you have to do it. It's just good to know, what you would need to do. But in general, we tell people to get their books and records in order. And then also the other piece is, a lot of business owners like to run a lot of expenses that could, that can be questionable as to whether or not it's considered a business expense or a personal expense. But of course, when it's for tax purposes, everyone wants to try to run every expense possible through and get as many deductions and minimize their income tax. But then turn around when it's time to sell your business, they want to claim that none of those expenses are actually real expenses. When you're actually considering a sale, you pretty much need to cut all of that out. You just need to suck it up and pay the taxes, because if you're running expenses that are not legitimate enough to be supporting the current revenue stream and level of operations, then you really don't want to be running it through your business and having it potentially impact your value if it's not deemed a credible add back for the purposes of adjustments.
Okay. And one other question, in terms of, particularly for businesses that are online, but regardless, the value of, say, your email list, how is that quantified, particularly for online businesses? How do you actually quantify that in the sale? What should a business owner be doing to maintain that, to show value in it?
Yeah, and that's a really good question as well. I mean, the intangibles of a business are always in question. And the short and not answer to your question is beauty is in the eye of the beholder. So that list will be of different value to different buyers. But in general, for purposes of valuation, your valuation of a business is based on the value of your entire entity as an ongoing concern, including the value of how you're leveraging that list to manage and keep the ongoing sales that you have. The concept is that, let's say you have an email list of 50,000 people that you're communicating with, and with that you're generating $4 or $5 million a year in sales. Well, the idea is that those sales are happening because you've managed to grow and create that list, and that's one of your intangible pieces of equipment that you use to produce the level of revenue that you have. So the short answer is that the value of that list is kind of embedded into the value of your business based on it being one of the tools that you use. But you have to factor in when you're selling to a strategic buyer who sees that list and realizes they can now take that list and cross-sell it to grow their revenues by 10 times. That list all of a sudden has a much different value. So I would say that for businesses that have a high level of intellectual property, and particularly things like mailing list, it's going to depend on the quality of that list, the level of detail that they have. So it's one thing to have names and email addresses, but you can't demonstrate whether or not those email whether those contacts actually interact with you, versus another to have an email list where you can say, this is how many touches I have, this is how I can demonstrate the activity I have with them, and this is all the other pieces of information I have about these people that allows me to understand how they can be of value to a strategic buyer. In that case, it'll actually up the premium paid for that business.
Okay. So can you see the question online, Mike, or I can read it?
Sorry, let me take a look here. Let's see.
And
if the business owner is a key employee, how can that affect the sale? How removed do you need to be from the actual running of your business before selling? That's a great question as well, because in most cases, the business owner is a key employee. It just depends. If you have created a business where you've got your processes and procedures fairly well documented, and you have the ability to transition your key knowledge over to a new owner in a relatively systematic manner, then it's not a major deal breaker. It's just something where you plan for it, but it doesn't impact materially the value of your sale. If it's a scenario where all the information's in your head, all the key customer relationships are based on your friendship and personal relationship with them, and the product production or service delivery couldn't happen without you, it's still an asset that has value. The difference is that you're going to have to get creative on your deal structure. So you're either going to take a big hit in your price because the buyer is taking a risk in trying to figure it all out again. And remember, the reason your business has value is because it's something that's already been created. If they're having to recreate it, then the value drops. But to the extent you have the ability to pass that value, then you still should be compensated for that value. But usually what happens in a scenario like that is we negotiate extended transition terms. So anytime you negotiate a purchase of a business, you're negotiating the sale price, how it's being financed, and then the terms and how it's transitioned. On a normal business price, $1 to $2 million or under, you'll see a transition period of anywhere from 4 to 12 weeks where the owner says, for this sale price, I'm agreeing to stay around at no additional charge for X number of hours per week, X number of hours in person and X remotely. And with those conditions, I will then support the new owner in figuring out how this all works. In the case of something where it's the business owner is a key, like for instance, a medical practice or architectural firms or things where it's or design practices. These are all examples where there's a lot of know-how that's tied. You'll usually see a transition period of up to a year in cases like that, and you tend to lose some of your options on financing through lenders, but you'll often see a good portion of your price tied to various metrics. So you might, like with a medical practice, we often will sell it for 50% of the sale value. The practitioner stays on for a year, and based on what percentage of current patient base is still remaining after a year, that determines the percentage of the remaining price paid.
Right. Any other questions? Feel free to add those in the chat box. Just another minute.
I mean, another thing too, for those that are on, I mean, for those of you who are finding that you're having to adapt business practices, I'd be curious to know like what kind of things you're doing that you're finding successful, whether it be adjusting how you communicate with your customers or how you deliver your product or service. I'm really been, as I've been working with my various clients, it's been very intriguing to me to see how people are adapting their business practices.
It's such a good question, Mike. And with you bringing that up, I just saw something pop up that the governor may extend or keep forever the delivery of alcohol.
Oh, thumbs up for that.
Yeah, so that literally just popped up about 5 minutes ago. Clearly, that's been successful.
That may explain why my text messages are starting to blow up.
Probably. So, any comments? Oh, and Maureen, can we unmute everyone? That's fine. Thomas, go ahead.
Yeah, I was going to just ask if there, I mean, you mentioned you'd seen some practices, like anything to note that you've seen that's been interesting?
I mean, so for me, I mean, the virtual showroom thing, and it sounds like a basic idea, but I was actually pretty surprised when I heard there were a couple of were having good strong with that. So they were having salespeople walking around with phones and FaceTiming. But let me think about that, because there's the big thing right now I've been working with my people on is, of course, trying to understand the SBA loans and helping them guide through that process. Delivery, I know the other thing is shifting. So for instance, we had an industrial distribution supplies company. They work on stocking nuts and bolts and hoses and similar type things like that. They're one of those examples of companies though that shifted and they started providing PPE products to their customers, and they have just blown up with demand for that. Of course, they were in a position where they were able to obtain those supplies, in mass bulk and then redistribute it at the retail level for those people who were having trouble find it. But that was an example of someone who totally out of their normal realm of product, but they shifted focus relatively quickly to adapt.
I was going to say one thing I'll share that someone just told me this morning from another business owner that they know, but the business owner works with PPE, equipment, et cetera, just basically selling it. So her natural inclination was to come out and just call anybody and everyone and say, hey, what PPE do you need? We can supply it. And just pepper out, emails and communications. But then she got really smart and said, you know what I'm going to do? I'm going to partner with 2 other people, and we're not going to sell this as PPE. We're going to sell this as a virtual virus management strategy and how we can help organizations from everything from training to the supply of PPE policies, procedures. So, and that's something she's not done before, but with the partner she's bringing in or the collaborators, feels very confident she can do that. I thought it was a great example.
Yeah.
Did someone else have another comment, question? Okay. All right. Well, Mike, thank you so much. We really, really appreciate it, and especially considering you're traveling right now. So thank you. Thank you for being here today, for sharing your expertise and your knowledge. We really, really appreciate it. Any parting words you want to share?
No, not really. I mean, I'm just here to offer myself as a support and resource for anybody. So I know I kind of, I apologize because of travel and some family things, I'm a little more disorganized than normal, but I've definitely seen a bunch of different stuff happening. And so to the extent anybody here or anybody else that you guys are connected to, whether through the chamber or just your own personal friends and family, feel free to pass my name and number. And I'm always happy to chat with anybody without it being tied to any kind of business deals. I mean, sometimes it's just nice to talk to someone who's seen it somewhere else. So I'm happy to extend that myself as a resource on that.
Thanks, Mike. And thanks for all of your support of the chamber. We really, really appreciate it. We'll get the recording and the presentation out as well. And everyone, listen, thank you for joining us today. Hope you can join us for the Chamber Connect tomorrow. Lighthearted fun. We've actually got something really fun planned. Shanice will be helping us moderate that, and we look forward to seeing everyone then. Have a great afternoon. Thank you.
Thank you.